Congress just quadrupled a tax break tied directly to your property tax bill. $10,000 for 7 years, now over $40,000. Verified card. Source: One Big Beautiful Bill Act, signed July 2025, raising the state and local tax deduction cap. That is real. That is signed. That is law right now. And here's the part almost nobody will tell you. There is a very good chance you cannot use a single dollar of it. Not because you do not qualify, not because you missed a form, not because anybody made a mistake, because of your age. There is a rule sitting underneath this that decides who actually gets the money, and it works almost perfectly backwards. The people with the biggest property tax bills, the people on fixed incomes, the people who have owned their homes the longest and paid the most in taxes over the years. Those are the people most likely to get nothing from this at all. And the people who benefit most are the ones still working, still in their 50s, still carrying a mortgage, MISP same law, same country, same property tax bill on the same street. One neighbor saves thousands, the other saves nothing. And the only real difference between them is what decade they were born in. And I want to be honest with you about why you have not heard this anywhere else. It is not being hidden. It is worse than that. It is being reported accurately and incompletely at the same time. Every article about this change says the cap went up 4 times over. That is true. Almost none of them say the sentence that comes next, which is who can actually use it. So millions of homeowners heard the good half of a fact and are now waiting on money that is never coming to them and will not find out until a tax preparer tells them next spring. This video is that conversation, 8 months early. Now stay with me, because there is one more thing. For the people this law leaves out, there is a completely legal move that can pull them back in. It costs nothing. It requires no application, no agency, and no permission from anybody. It is a matter of timing, and almost nobody has ever heard of it. Before this video ends, I will show you exactly how it works. My name is Kevin. I read the rules so you do not have to. If you are new here, this channel exists for one reason. We read the fine print that decides what happens to your money, so you find out before the system decides for you. Subscribe and turn on the bell, because this one has a deadline attached to it, and the deadline is real. Let me start with what actually changed, because you cannot see the trap until you understand the rule. When you file your federal taxes, you are allowed to deduct certain state and local taxes you paid during the year. Your property tax, your state income tax, in some cases your sales tax instead. Verified card. Source: Federal deduction for state and local taxes under Internal Revenue Code, Section 164. For most of the last century, there was no dollar limit on that at all. You paid it, you deducted it. Then, in 2017, a cap was put on it. $10,000 total for everything combined. Verified card. Source: Tax Cuts and Jobs Act of 2017, $10,000 SALT deduction cap. Now think about what that $10,000 ceiling did to real households. In plenty of places in this country, property tax alone on an ordinary house runs $8,000, $10,000, $12,000 a year. Add a state income tax on top, and you are well past that ceiling before you have counted anything else. So people were paying taxes they could not deduct, year after year, for 7 straight years. And that hit certain parts of the country far harder than others. If you live somewhere with high property values and a state income tax on top, that $10,000 ceiling was not close to your actual bill. It was a fraction of it. If you live somewhere with low property taxes and no state income tax, you may never have bumped into that ceiling at all and never thought about it once. Same federal law. Completely different experience of it depending entirely on which state you happen to live in. That geography question is about to matter again in this video, because it decides the size of the pile you are trying to stack up. That is what just changed. The cap went from $10,000 to $40,000, and it steps up slightly again each year after that. Verified card. Source: OBBBA raised the SALT cap to $40,000 for 2025 and just over $40,000 for 2026, increasing about 1% annually through 2029. 4 times higher, overnight, on a tax break tied directly to the property tax bill sitting on your kitchen table. That is a genuinely large change, and it is not a proposal, and it is not a rumor. It is in force. Now here is the sentence that decides everything, and it is the sentence nobody puts in a headline. That deduction only exists if you itemize. Verified card. Source: the SALT deduction is an itemized deduction claimed on Schedule A. Let me explain what that means in plain language, because this single idea is the whole video. Every year when you file, you get a choice. You can take the standard deduction. That is one flat number given to everybody. No receipts, no records, no proof of anything. Or you can itemize. That means adding up your actual deductible expenses one by one and using that total instead. You do not get both. You get whichever one is larger. So the property tax deduction is not a check. It is not a rebate. It is not money the government sends you. It is a number that only matters if your itemized total beats your standard deduction. And if it does not beat it, then everything you paid in property tax that year did absolutely nothing for your federal taxes. Not reduced, not partially counted, nothing. And there is a second misunderstanding sitting right next to this one, so let me clear it now. A deduction is not the same as a credit, and people use those words as if they mean the same thing. A credit comes straight off your tax bill. A $1,000 credit means you owe $1,000 less, dollar for dollar. A deduction only reduces the income you are taxed on. So a $1,000 deduction is worth whatever your tax rate is on that $1,000. It might be worth a couple $100, not $1,000. Verified card. Source: a tax deduction reduces taxable income. A tax credit reduces tax owed directly. Which means even for the people who do get to use this, the benefit is not the full amount of the deduction. It is a percentage of it. Still real money, still worth having, but nowhere near what most people picture when they hear a number like $40,000. And it is worth knowing that before you build any expectation on it. Now watch what happens when you put age into that equation, because this is where the trap lives. The standard deduction is not the same for everybody. If you are 65 or older, you get an additional amount on top of the regular standard deduction. That has been true for a long time. Verified card. Source: additional standard deduction for taxpayers aged 65 and over. And on top of that, there is now a new senior deduction as well, from the same law that raised the property tax cap. Verified card. Source: OBBB, a temporary additional deduction for taxpayers aged 65 and over. Now, both of those are good things. I want to say that clearly. Every dollar added to your standard deduction is a dollar of income the government does not tax. That is real money in your pocket, automatically, with no forms and no effort. But look at what it does to the other side of the ledger. The higher your standard deduction climbs, the higher the bar your itemized total has to clear before itemizing does you any good at all. So Congress raised the property tax deduction limit with one hand, and with the other hand, for people over 65, it raised the wall you have to climb before you can reach it. Nobody designed that as a trick. I do not think there is a villain in this story, but the effect is exactly the same as if somebody had. The two changes work against each other, and the person caught in the middle is a homeowner over 65 with a large property tax bill and no idea why the new law did nothing for them. Let me put three neighbors on the same street and show you how differently this lands. Start with Lyle. Lyle is 56. He lives outside Naperville, Illinois. He is still working, still has about 9 years left on his mortgage, and his wife works part-time. Here is what Lyle's tax return looks like. Property tax on the house. State income tax withheld out of both paychecks all year long. Mortgage interest, which is still substantial because he is not that far into the loan. Add those together and Lyle clears the standard deduction without much trouble, which means Lyle itemizes. And because he itemizes, the jump from $10,000 to over $40,000 is real money in his pocket. He deducts property tax he was never allowed to deduct before. He deducts state income tax he was losing entirely. For a household like his, that change can be worth thousands of dollars a year. Now walk 2 doors down to Maudie. Maudie is 68, same street, similar house, nearly identical property tax bill. But Maudie's picture is completely different. She retired 3 years ago, so there is no paycheck with state income tax coming out of it anymore. Social Security is not taxed by her state at all. She paid her house off 11 years ago, so there is no mortgage interest. So what does Maudie have to itemize? Her property tax, and essentially nothing else. Meanwhile, her standard deduction is higher than Lyle's because she is over 65 and gets the extra amounts. Bigger standard deduction, smaller pile of itemized expenses. The gap between them is not close. Maudie takes the standard deduction, like she has every year since she retired, which means the entire change to the property tax cap, the 4 times increase Congress just passed, is worth exactly $0 to her. Zero. Not a little, not a partial amount, zero. And I want to be fair and complete here, because Maudie's situation is not identical everywhere. In a state with a high income tax that reaches retirement income, a retiree might still have a significant state tax bill to itemize. In a state with no income tax at all, a working person's itemized pile is smaller than Lyle's would be. Verified card. Source. State income tax treatment of retirement income varies by state. So the exact shape of this changes depending on where you live, and I am not going to pretend one example covers 50 states. But the direction holds almost everywhere. When the paycheck stops and the mortgage is gone, the itemized pile shrinks. And when you turn 65, the number you have to beat gets bigger. Those two forces point the same way regardless of your zip code. And she pays roughly the same property tax bill as the man 2 doors down who is saving thousands from it. Now go one more house down to Chester. Chester is 74. He is the one this hits hardest. And he is also the one most likely to have heard about the new law and gotten his hopes up. Chester has lived in that house for 38 years. He has paid property tax on it every single year since Ronald Reagan was president. His bill is the highest of the 3 because his home has appreciated the most and his county has reassessed it repeatedly. And Chester has the largest standard deduction of the 3 because he is the oldest. No mortgage, no state income tax withholding, one enormous property tax bill and nothing else on the itemized side. So the man who has paid the most property tax, for the longest, on the highest bill, gets the least benefit from a law that just quadrupled the property tax deduction. That is the age trap. Not a conspiracy, just arithmetic that nobody explained to him. And here's what I want you to sit with, because this is the part that got me. If you asked those 3 men which one of them the new law was written for, every one of them would have guessed Chester. He is the retiree. He is on the fixed income. He is the one whose tax bill outgrew his income years ago. Everybody's instinct says the help goes to him, and the arithmetic sends it to the 56-year-old with 2 paychecks and a mortgage. And that is not unique to this law. That is how nearly every deduction in the federal tax code works. Deductions reward the people with enough deductible activity to clear a threshold. Mortgages, payroll withholding, business expenses, all the things that come with still being in the middle of a working financial life. A paid-off house and a fixed income produce almost none of that. Not because the person is doing anything wrong, because they finished doing the things the tax code rewards. So the tax code quietly stops noticing you right around the time your bills stop shrinking. Nobody announces it. It just happens, one deduction at a time. Now I want to stop here because Chester is the exact reason I built the thing I am about to tell you about. He is not confused because he is careless. He is confused because nobody in this country has ever sat down and explained the difference between a deduction and a check, in plain language, to the people it decides things for. He heard Congress raise the property tax break. He assumed that meant his property tax bill would go down. That is a completely reasonable assumption, and it is wrong. And there was nowhere he could have gone to find that out. That is what the Quiet Rules is. It is the drawer version of everything I cover on this channel. Written large, written simple. What a deduction actually is and is not. How to tell in about 4 minutes whether you itemize or not. Which numbers to compare and where to find them on a return you already have. So the person at the kitchen table, hearing about a new tax law, knows in one sitting whether it touches them, instead of waiting a year to find out it never did. The paper remembers for you. That is the entire point of paper. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment at the top. And there is a 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. Because the alternative is a man who has paid property tax for 38 years, believing help arrived and never learning it did not. If nobody has ever explained the difference between a deduction and a refund to you before today, do me one favor. Subscribe and turn on the bell. Because this channel reads the fine print that nobody mails to your house. Now let me give you the second half of this, because there is a group I have not covered yet, and they are in the most precarious position of all. The people in their 60s, the ones in the middle of the change. Because there is a specific year in your life when you can flip from one side of this to the other without doing anything at all. The year you retire. Think about what stops the day you stop working. The state income tax coming out of your paycheck stops. That was very possibly the single largest thing on your itemized list, and it vanishes. So a person who itemized comfortably for 20 straight years can, in the space of 1 calendar year, drop below the line and never itemize again for the rest of their life. Nobody tells you that. Your tax software will simply switch you over quietly, and you will never know anything changed. And that quiet switch has a real consequence beyond the money. Once you stop itemizing, the receipts stop mattering. The charitable donation letters stop mattering. The records people keep faithfully in a shoebox all year suddenly do nothing, which is fine as long as you know it happened. What is not fine is a household still organizing its year around deductions that stopped counting 3 years ago. That is time and effort spent for nothing, and it is very common because the switch happens silently inside a piece of software. And that same year is very often the year your standard deduction goes up, because turning 65 triggers the additional amount. So both sides of the equation move at once, and both of them move against itemizing. Which brings me to what I promised you at the start of this video. There is a way to pull yourself back over that line. It is completely legal, it costs nothing, and it is available to almost anybody with a property tax bill. It is called bunching, and the entire idea is timing. Here is the problem it solves. Say your itemized total lands just under your standard deduction, not far under, a few $1,000s short. Every year you fall short. Every year you take the standard deduction, and every year your property tax bill does nothing for you at all. Now here is the move. Instead of spreading your deductible expenses evenly across every year, you push 2 years' worth into 1 year. For property tax specifically, most counties send bills in a way that gives you a window at the turn of the calendar. If you pay 1 year's bill in December and the next year's bill in January, those 2 payments fall in 2 different tax years, 1 each. But if you pay one in January and the next one in December of that same year, both of them land inside 1 single tax year. Verified card. Source. Deductions are generally claimed in the tax year the payment is actually made. Now look at what that does. In that doubled year, your itemized total is suddenly much larger. 2 property tax bills instead of 1. And you clear the standard deduction easily, so you itemize and you get real benefit. Then the following year, you have no property tax payment to deduct, so you simply take the standard deduction, which you were taking anyway. Same money, same bills, same house. But instead of falling short every single year and getting nothing, you get full benefit every other year. And this is not a loophole somebody found. It is not aggressive. It is not a gray area. It is simply the fact that a deduction lands in the year you actually pay it, and you often have some control over when you pay. Now, I owe you the limits on this because I am not going to oversell it. You need to be able to afford 2 bills in 1 year. That is a real cash flow question, and for a lot of households, the answer is no. Your county has to allow the timing. Some let you pay early, some do not. And if you have a mortgage escrow paying your property tax for you, you generally do not control the timing at all. Although that is worth 1 phone call rather than an assumption. Some servicers will let you handle a payment directly if you ask. Some will not. But the people who never ask are automatically in the group that cannot do it, and the people who ask sometimes find out they can. That is a 5-minute call, and the answer is either no, and you have lost 5 minutes, or yes, and you have opened a door that was going to stay closed forever. It also works better the closer you already are to the line. If your itemized total is a few thousand short, doubling 1 item can carry you over easily. If you are 10,000 short, 1 extra property tax bill may not get there. And property tax is not the only thing that can be timed this way. Charitable giving works on exactly the same principle, and for many households it is easier to move than a tax bill is. 2 years of giving concentrated into 1 year, then nothing the following year. Verified card. Source. Charitable contributions are deductible in the year the gift is made. Combine the two, a doubled property tax year and a doubled giving year in the same year, and a household that never clears the line can clear it comfortably every other year. Nothing about what you spend has changed, only when you spend it. That is the entire idea, and it is worth saying plainly one more time because it sounds too simple to be real. The government does not care that you pay the same amount over 2 years. It cares which calendar year the payment landed in. And for a great many people, that is the only lever they have left. But for the household sitting just under that line, year after year getting nothing, year after year, this one decision about which month you write a check can be worth real money. And almost nobody has ever heard of it because it is not a program. There is no form, there is no office. It is just knowledge, and knowledge does not get mailed to anybody. And that is exactly what the quiet rules holds. How to work out where you actually stand relative to the line. What the timing rules are and what to ask your county before you move a payment. What questions to bring to whoever prepares your taxes, so you are not paying somebody to explain the basics on the clock. For this and for every rule in this video, sitting in the drawer, in plain English, before the calendar year closes, not after. You can find it at kevinexplains.shop. The link is in the description and in the pinned comment at the top, or scan the QR code on your screen right now. 7-day guarantee, no questions asked. Because the alternative is falling a few $1,000s short of a line every single year for the rest of your life, without ever knowing the line was there. Now, there is a second thing to know, and it matters most for people in their 50s and early 60s. That expanded cap does not last. Under the law as written, the higher limit runs for a set number of years and then drops back down to where it was. Verified card. Source: the expanded SALT cap is scheduled to revert to $10,000 in 2030. Back to $10,000, the same ceiling that was squeezing people for 7 years. So this is not a permanent change to the tax code, it is a window. And a window has two ends. It opened, and it is scheduled to close. And everything you do inside it is worth more than the same thing done outside it, which changes how you think about certain decisions. If you are weighing something that would put you over the itemizing line, the years inside this window are the valuable ones. If you are planning to retire and your itemizing is going to collapse when your paycheck stops, the years before that happen are the ones that matter. There is also a limit on the other end that catches higher earners, and I want to mention it for completeness. The expanded amount phases down for people above a fairly high income threshold, and above a certain point they end up right back at the old $10,000 cap. Verified card. Source: the expanded SALT cap phases down above a modified adjusted gross income threshold and does not fall below $10,000. That will not apply to most people watching this, but if you had an unusually large income year, a home sale, a big retirement account withdrawal, that is worth knowing before you plan around the higher number. Now let me pull all of this together, because I want you to leave with the picture rather than a pile of numbers. The cap on deducting state and local taxes, which includes your property tax, went from $10,000 to over $40,000. That is real, and it is in force right now. But it only reaches you if you itemize. And whether you itemize depends heavily on your age, because the standard deduction you have to beat grows once you turn 65. Which means the benefit tilts toward people still working, still paying state income tax out of a paycheck, still carrying a mortgage. And it tilts away from exactly the people whose property tax bills hurt the most. The year you retire can quietly move you from one side of that line to the other, permanently, without anybody telling you. And the window on the higher cap is scheduled to close, so the years inside it are the valuable ones. Now here's your checklist. 4 things, and none of them take long. 1. Pull out last year's tax return and find out whether you itemized or took the standard deduction. That single fact determines whether any of this touches you, and most people genuinely do not know which one they did. 2. If you took the standard deduction, add up what you would have itemized. Property tax, state income tax if you paid any, mortgage interest, charitable giving. Find out how far short you actually fall. Close is a completely different situation from nowhere near. 3. If you are close, look at the timing of your property tax payments and find out whether your county lets you pay in a way that would put 2 bills in 1 calendar year. Then talk it through with whoever prepares your taxes before you move a dollar. 4. If you are approaching retirement, understand that the year your paycheck stops may also be the year your itemizing stops. Do not be surprised by it. Plan around it while you still have the choice. And I want to say one thing to the people who just realized none of this reaches them. If you are Chester, if you are on a fixed income with a paid-off house and a property tax bill that keeps climbing, this federal change is not your fight. Your fight is local. It always has been. The exemptions, freezes, and deferrals that actually lower a property tax bill for older homeowners are set by your state and your county, not by Congress. Verified card. Source: property taxes are levied and administered at the state and local level. That is not a consolation prize. In dollar terms, it is very often worth more than any federal deduction would have been. But it is a completely different door, and knowing which door is yours is the whole point of this video. And the difference between those two doors is worth stating plainly one more time. The federal door is a deduction. It reduces the income you are taxed on, only if you itemize, and it is worth a percentage of the amount rather than the whole thing. The local door reduces the bill itself, not the income it is calculated from, the bill. Which is why, for a homeowner on a fixed income, the local door is almost always the bigger one, even though the federal one is the one making headlines. The headlines follow Congress because Congress is national news. Your county assessor is not national news. But your county assessor has more control over what you actually pay than Congress does. And if your own situation is genuinely unclear, if you cannot tell whether you itemize or whether any of this reaches you, email me. The address is on your screen and in the description below. I read every one. Let me leave you with the thing I most want you to keep. Lyle, at 56, saves thousands of dollars from this law and did not have to do anything to get it. Maudie, at 68, gets nothing on a nearly identical house on the same street. And Chester, at 74, who has paid property tax on that street since before either of them moved in, gets the least of all three. Not one of them made a mistake. Not one of them filed anything wrong. Not one of them missed a deadline. The law simply arrived at 3 houses in a row and did 3 completely different things, for reasons none of them were ever told. That is what almost every rule I cover on this channel has in common. It is not that the system is hiding anything, it is that the system publishes the rule and never once explains who it actually lands on. So find out which one of those 3 houses you are standing in. It takes one old tax return and about 10 minutes, and it is the difference between waiting a year for a benefit that was never coming and knowing today exactly where your money is and is not. And tell somebody. That is the part that costs nothing at all, because there is somebody in your life right now who heard that Congress raised the property tax break and quietly adjusted what they think next year looks like. One sentence from you, that it only counts if you itemize, saves them from finding out the hard way in April. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.